Money worries are nothing new. For thousands of years, people have stressed about paying bills, saving for the future, and making ends meet. From ancient farmers counting grain to modern families planning budgets, our concerns are surprisingly similar. The ways we trade, save, and borrow have changed, but the story of money connects us all. How did we get from trading goats to tapping our phones to pay for coffee? The journey of money began with bartering, then evolved to shells, coins, and paper. Today, we use digital banking and instant payments. But the questions remain: how do we protect what we have, make it grow, and build a secure future? Let's explore the journey of your wallet. Before money, people traded goods and services directly, a system called barter. You might swap pots for fish or wheat for an axe. Barter worked in small communities but had big problems. Trades required a double coincidence of wants, finding someone who wanted what you had. Value was hard to agree on, and goods weren't always easy to divide or store. These challenges led to the invention of money, a better way to trade. Bartering was frustrating, so people began using items like salt or shells as money, commodity money. This made trade smoother, but these items weren't perfect. Around 600 BC, Lydia minted the world's first coins, small stamped pieces of electrum. Coins were portable, durable, and guaranteed by authority. Soon, Greeks, Romans, and Persians minted their own coins, making trade easier. Money became an abstract tool, something to save, count, and build a future with. With the invention of coins, people could finally save for the future in a practical way. Unlike grain that rots or livestock that dies, coins could be stored for years without losing their value. This introduced a new level of financial security into people's lives. An artisan or a soldier could slowly accumulate a small stash of silver coins, tucking them away for a future purchase, an emergency, or their old age. This was really the birth of personal savings. People would often bury their savings in a clay pot in their backyard, the original piggy bank. Archaeologists have uncovered many of these ancient coin hoards, giving us a direct glimpse into the financial lives of our ancestors. Of course, just as saving became possible, so did borrowing. In ancient societies like Mesopotamia and Babylon, lending was already a well-established practice, even before coins. Detailed records of loans were inscribed on clay tablets. The famous Code of Hammurabi, a Babylonian legal text from around 1750 BC, included specific laws about borrowing and lending. It set maximum interest rates for loans of grain and silver, protecting borrowers from outrageously high charges. This shows that even thousands of years ago, societies recognized the need to regulate financial transactions to ensure fairness and prevent people from falling into inescapable cycles of debt. The arrival of coinage made lending and borrowing even more common. In ancient Greece and Rome, banking became a formal profession. Moneylenders, known as trapezitai in Greece, would set up tables or trapeza in the marketplace. They would accept deposits for safekeeping, exchange different types of currency, and provide loans to merchants, farmers, and even city-states. While these early banks were simple by today's standards, they served the same essential functions, keeping money safe and making capital available to those who needed it. They were the engines that helped fuel the vibrant economies of these ancient empires. However, debt was a serious and often dangerous part of ancient life. If you couldn't repay a loan, the consequences were severe. In many societies, you could be forced into debt bondage, essentially becoming a slave to your creditor until the debt was worked off. In some cases, your family members could be sold to cover your obligations. This constant threat of losing one's freedom made financial decisions incredibly high stakes. People had to be extremely careful about taking on debt. It's a powerful reminder that while our financial tools have evolved, the fundamental principles of living within our means and borrowing responsibly are as critical today as they were thousands of years ago. After Rome's fall, Europe fractured into countless kingdoms, each minting its own coins. Merchants needed to juggle many currencies, with values shifting by region and ruler. Money changers emerged, setting up benches in markets to exchange coins for a fee, essential for trade. For most, coins were rare. Rural life ran on barter and feudal obligations. paying rent with crops or labor, not cash. Trusted coins like the Byzantine solidus and English silver penny circulated widely, but most people's finances stayed local. The average person focused on survival, feeding the family, paying dues, and saving a few coins for emergencies. Personal finance was about managing goods and obligations, not investments or banking. It was a world of tangible assets and local concerns. As trade revived in medieval Italy, money changers evolved into the first banks, run by powerful families. Banks accepted deposits, offered loans, and charged interest, fueling economic growth. The bill of exchange let merchants travel without carrying gold, making commerce safer and more efficient. Banking families like the Medicis lent to merchants, popes, and kings, shaping European finance. For ordinary people, debt was risky. Religious laws against usury pushed many to high-interest moneylenders. Falling into debt could mean losing everything, so careful money management was crucial. These innovations laid the groundwork for modern banking. Medieval life was risky. Ships sank, crops failed, fortunes vanished. Merchants invented marine insurance, pooling funds to cover losses at sea, spreading risk and encouraging trade. Guilds, associations of craftsmen, offered support dues, funded aid for sick members, funerals, and families in need. Guilds acted as early unions, pension funds, and insurance, providing security in a world without government welfare. Belonging to a guild meant mutual support and collective responsibility. These systems taught the value of planning for emergencies and helping each other. Even centuries ago, people understood the need for financial safety nets. The roots of modern insurance and social support run deep. The Industrial Revolution created a new class: wage earners. People left farms for factory jobs, earning regular cash wages instead of seasonal harvests. Weekly paychecks brought stability and made budgeting essential. But wages were low, work was harsh, and every necessity, rent, food, fuel, had to be bought with cash. Families became meticulous budgeters, stretching every penny to survive. Any unexpected expense could trigger a crisis. The kitchen table became the family's accounting office, planning how to make ends meet. This era shaped the basics of personal finance: income, expenses, and survival. Industrialization spurred new banks for workers. Savings banks and penny banks encouraged thrift and security. Even tiny deposits were welcome, helping families build a safety net for illness or emergencies. Informal savings clubs and friendly societies pooled resources for loans or home purchases, built on trust and community. Despite these advances, debt was a constant threat. Many turned to pawnbrokers or predatory lenders. The truck system trapped workers, paying them in tokens only usable at overpriced company stores. Finance could empower, but also ensnare the vulnerable. The era revealed both the promise and peril of money management. For ordinary people, financial tools were a lifeline, and sometimes a trap. As the Industrial Revolution progressed and a new middle class of managers, engineers, and shop owners emerged, the world of personal finance began to look more familiar to us today. This group had more disposable income than factory workers, and they started looking for ways to make their money grow. The concept of investing began to move beyond just the super wealthy. Stock markets, which had existed for a while, became more accessible. People could buy shares in the new railroad, canal, or manufacturing companies that were driving the economic boom. This offered the potential for much higher returns than a simple savings account, but it also came with much greater risk. This period saw the birth of the small individual investor. A successful shopkeeper or a doctor might decide to invest a portion of his savings in railway stock, hoping to profit from the expansion of this transformative technology. Financial newspapers and magazines began to appear, offering news and advice about different companies and investments. Of course, this new world was a wild and unregulated frontier. Stock market crashes could and did happen, wiping out the savings of many inexperienced investors overnight. People learned the hard way about the volatility of markets and the importance of not putting all their eggs in one basket, a lesson that remains central to investing today. Life insurance also became much more widespread and sophisticated during this era. While early forms of insurance existed before, companies like the Prudential Assurance Company in the United Kingdom began to actively market policies to the working and middle classes. They introduced the industrial branch system, where agents would go door to door to collect small weekly premiums. This made life insurance affordable for millions of families for the first time. For a few pennies a week, a breadwinner could ensure that if he died unexpectedly, his family would receive a lump sum payment to cover funeral costs and provide some financial support. This was a monumental step in family financial planning. These developments marked a significant shift in personal finance. The focus expanded beyond mere survival and short-term saving. People began to engage in long-term financial planning, thinking about retirement, protecting their families from disaster, and actively trying to grow their wealth. The tools they used, savings accounts, stocks, and life insurance, are the same core products that form the foundation of our own financial plans. The Industrial Revolution created not only a new economy, but also a new set of financial challenges and opportunities, forcing people to become more deliberate and forward-thinking managers of their own money than ever before. The credit card, first introduced in the 1950s, revolutionized how people shop and spend. Suddenly you could buy now and pay later. No need for cash or loans for every purchase. But this convenience came with a hidden risk: debt. Swiping a card made it easy to overspend, and high interest rates trapped many in cycles of debt. Credit cards offered freedom, but demanded new financial discipline and awareness. The second half of the 20th century also democratized the world of investing. Previously, owning stocks was primarily for the wealthy, but the creation of the mutual fund changed everything. A mutual fund pools money from thousands of small investors and uses it to buy a wide variety of stocks, bonds, or other assets. This allowed ordinary people to invest in the stock market without needing a fortune or deep expertise. For a relatively small amount of money, you could own a tiny piece of hundreds of different companies. This was a brilliant way to diversify, which means spreading your risk so that you don't have all your eggs in one basket. This innovation made investing accessible and less intimidating for the middle class. You no longer had to be a financial genius who could pick winning stocks. Instead, you could simply buy into a mutual fund and let a professional manager handle the decisions. This opened the door for millions of people to participate in the growth of the economy and build long-term wealth. Alongside mutual funds, new types of retirement accounts were created, such as the 401k in the United States. These plans offered powerful tax advantages, encouraging people to save consistently for their later years directly from their paychecks, often with a matching contribution from their employer. These tools fundamentally changed how people approached retirement planning. In earlier generations, many workers could count on a pension from their employer, which provided a guaranteed monthly income for life. But pensions started to become less common. The responsibility for saving for retirement shifted from the company to the individual. Your financial security in old age now depended on your own savings and investment choices throughout your working life. This made personal financial planning more critical than ever. People had to learn about asset allocation, compound interest, and how to build a nest egg that could last for several decades. This new era of personal responsibility for retirement created both opportunity and anxiety. On one hand, you had more control over your financial future than ever before. Smart saving and investing could lead to a very comfortable retirement. On the other hand, it placed a significant burden on individuals to make wise decisions in a complex financial world. Making a mistake, like investing too conservatively or not saving enough, could have serious consequences down the road. Financial literacy became an essential life skill, necessary for navigating the journey from your first paycheck to your last, ensuring you had enough to live on when you were no longer working. In the 21st century, banking transformed. Online and mobile apps put your finances at your fingertips. No more waiting in line. You can check balances, pay bills, deposit checks, and send money instantly, all from your phone. But with this convenience comes new risks, like online fraud. Today, being financially savvy means mastering both digital tools and security in our connected world. Throughout history, people have used some truly strange things as money. From cowrie shells and salt to giant stone wheels on the island of Yap, money has taken wild forms. Ancient China even used bronze knives and shovels as currency. In medieval Europe, tally sticks tracked debts, split in half for security, and in 19th century America, furniture was sold on installment plans, an early form of consumer credit. Even insurance began in a London coffee house, where merchants shared risk and news. In the end, money is just what we all agree it is, no matter how weird. Financial tools change, but human behavior stays the same. From ancient Babylonians to today, we worry about debt, protect our wealth, and seek community support. The most effective habits are simple. Spend less than you earn, save, and protect yourself. New tools bring new risks, so use them wisely. Financial literacy and community remain our greatest strengths. From ancient markets to digital wallets, the basics of personal finance remain unchanged. Live within your means, avoid bad debt, and keep learning. History shows that those who save, budget, and use credit wisely build security, no matter the era. Embrace timeless lessons and modern tools to shape your financial future with confidence.